AWA, Alexander Watson Associates, we believe you should have access to every resource your business needs to succeed. We ask the right questions, we listen, and provide answers that you can act upon with confidence. Our global business is facilitating the growth of yours. The difference between simply surviving and strategic growth is the intelligence that creates your strategy. AWA is your trusted business-to-business market research, publishing, conferences and events, and advisory services company with the unique industry focus on the specialty paper, film, packaging, coating, and converting sector.
Since 1971, we have provided industry-leading, reliable, and cost-effective market information. Our portfolio of published studies is thorough and relevant for your business to grow effectively, and we provide a wide range of tailor-made services for clients. As a guarantee of quality and accountability, our experts are engaged in every phase of the project.
Our outcome-driven market due diligence and M&A services provide support for high-value, no-surprise transactions. Clients are provided with in-depth knowledge and market understanding to execute successful deals.
Through AWA conferences and events, we provide a platform of industry-specific physical and virtual events, facilitating information sharing, networking, and providing insights to help your business grow.
We are here to help you navigate the complexities of the market today. We are your platform for your informational needs. Hello, good afternoon, good morning, depending where across the Atlantic you are. My name is Corey Reardon, President and CEO of AWA Alexander Watson Associates. And I'd like to invite and welcome everyone to this year's AWAVirtual Mergers and Acquisition Executive Forum on the packaging and labeling sector. That intro video provided a quick overview about AWA and where our expertise lies as a boutique SME within the sector, here to support a range of market, industry, and VOC due diligence. I would also like to start today's program by acknowledging and thanking our sponsors and contributors, Blaze, Mergerware, Maison and Associates, William Blair, and last but not least, Graphic Arts Advisors. This annual AWAVirtual Forum for the packaging and labeling sector is an online international mergers and acquisition event for all those involved or interested in the packaging and labeling sector. Today brings together C-level executives, private equity firms, investment bankers, and suppliers to create an industry-focused forum for all those involved or interested in M&A across the packaging and labeling sector. Today, we are joined by over 200 registered participants. So I look forward to the program and sharing some insights and having interesting discussions with our panelists and moderators. This year's program features a selection of presentations and panel discussions focused on M&A drivers, trends, and industry insights, providing a snapshot of major themes across the M&A packaging and labeling marketplace. Today's program will highlight a discussion on preferred packaging sector for private equity investors, moderated by Thomas Blage, the CEO of Blage & Company. It will also feature technologies to elevate M&A deal success, presented by our CEO from Mergerware. A presentation on global M&A trends in packaging will be presented by Stuart Sanford, the director from Maison and Associates, followed by a roundtable discussion on navigating cross-border M&A transactions and reviewing the challenges, opportunities, and current environment, particularly as it relates to cross-border M&A transactions. And we'll finish up the program today with an endnote and Q&A on the current state of M&A in the packaging sector from Brian Flynn, the Managing Director of Investment Banking at William Blair. The packaging and labeling sector is quite dynamic with generally good growth characteristics across the board, with pockets of high growth in specific niches and particular value-added segments. After quite a turbulent period of COVID-19, supply chain disruptions, erratic supply-demand characteristics, overstocking, destocking, and economic uncertainties the last few years, prospects are looking fairly good moving forward for the sector. Sustainability is the overriding trend and key drivers of innovation, providing leverage for the sector as both a threat and an opportunity. In January of every year, AWA holds its annual AWAVirtual Insights Forum, addressing strategic and thought leadership issues across the sector. In addition to sustainability, innovation and technology, automation, DE&I, and other leadership challenges create a backdrop as the macro trends across the industry, which were covered in the last Insights Forum. I would like to share with you the following video, which will highlight and recap the last AWAVirtual Insights Forum as a start to today's program and discussions around M&A. Welcome to this year's AWAVirtual Insights Forum, which we're pleased to host today.
Packaging is one of those industries that's gone from being a box once before it was just a protective item for food a long time ago. It became something to present the brand and then something to present information about the product. Augmented reality, personalised data coming together to present content in some sort of sense around the package which is personalised for the consumer, along the lines of what I talked about before. And there's some great opportunities there to create campaigns or even create an environment or an ecosystem where your product becomes the source of its own information.
Already 2-3 years ago, we had this sort of statement at IPA, data is the new oil. So all this data is generated already. The question is, what are you going to do with it?
Educating ourselves on it has led us to ask much better questions of our suppliers. Mm-hmm. And like, what are you doing with predictive maintenance?
What D&I is, start measuring it, start celebrating it, creating programs, and really focusing on increasing our collective competency in this area.
It's not about, a game of subtraction or leaving anyone behind. It's quite the opposite. This work is all around leveling the playing field for everyone and creating an environment where everyone who aspires to can reach their full potential within an organization.
And we need to be able to have the frank and brave conversations and really listen to each other and make sure that all perspectives are brought to the table and are understood.
Do you think we, all of us working on inclusion and diversity, will we ever be done? Will our job ever be finished?
It really takes leadership at the top of the organization to help us and kind of enable us to go and do this very important work. I can tell you several years ago, and I've been with Nestle for 31 years, it would be uncommon to be at a table with your various competitors talking about common goals and solutions.
How we manage sustainability and how we manage digitization, including leveraging AI, will largely depend will largely influence the growth of our industry. DE&I plays a key role in order to be inclusive and have those new capabilities and to attract talent with different skill sets.
The world is changing, people are changing, we are all working in manufacturing environments. How do we keep young people engaged and motivated to work in a manufacturing company, to work in shift models, etc.? I think that's one of the key challenges for the future.
When we think about material that end up in a landfill, for instance, and we want to recycle them and recycle them back to the beginning of the food chain, I don't believe we will be able to do that alone. I think we will have to take this, from a collaboration perspective with our competitors in order to reorganize all that together for the benefit of the industry.
What are the opportunities? What are the barriers? What are the unmet needs, particularly in light of sustainability and digitization? And how can we drive game-changing innovation? I think it's absolutely critical for our industry to grow and to stay relevant. And if we don't manage that, then we might face more headwinds than tailwinds. So I think it's absolutely critical to take destiny into our own hands.
We're optimistic that 2024 will continue to improve from 2023 levels of destocking and volumes being depressed. I think that provides a good backdrop for, some of the challenges and the opportunities the label and packaging sector is facing, whether it's sustainability, innovation, technology, automation, D&I, or other leadership challenges. These are all helping to shape and drive the labeling and packaging sector, and certainly become important macro trends and issues being faced with regardless of any M&A transaction or opportunity being looked at. So it's a good place to start, particularly with our first roundtable panel discussion, which is being moderated by Thomas Blage, the chairman and CEO of Blage & Company. Thomas was the founder of Blage & Company and has over 30 years experience in transactions across the packaging sector. The Blage team has completed over 200 transactions and had visited over 600 label, plastic, packaging, and chemical companies as part of their worldwide focus in the mergers and acquisition field within the industry. The company is a specialist investment bank with a deeper and broader knowledge of its target audience versus most generalist banks, and has been focused on the packaging sector for over 30 years. The UK-based magazine Acquisition International named Thomas Blage the 2015 sector-focused CEO of the year, and has won other industry awards over the years, and is really a leader in understanding the market and M&A transactions. He's going to be joined by a panel that he'll introduce, but speaking about the preferred packaging sectors for private equity firms, and where the interest lies and where the growth opportunities are. So it's my pleasure to introduce, as our first roundtable discussion, Thomas Blage and his panelists, Paul Ebert, Evan Golden, and Damon Thome, who will, I'm sure, provide us with a very interesting and thought-provoking discussion around the preferred packaging sectors for private equity to focus on. So over to you, Thomas, and look forward to the discussion.
Thank you, and good morning, good afternoon, good evening to all, depending on where you're virtually connecting from. We're excited to be here again at the AWA annual virtual M&A forum. We've got a distinguished guest of panelists here. As Corey had said, you got Paul, Evan, and Damon. I'll let them go through and introduce themselves. I would just say that there's a segment here for some, a few minutes just on trends and and observations here in the M&A market currently. And there's some slides in the deck that Corey certainly could pass around. But I think Corey has summarized it very effectively in his introduction. I would just make 5 quick points on the research. Blage & Company is an advisor, sell-side advisor, and Blage Analytics is a research house doing industry research and analytics, really focused on this industry. In terms of that data, the packaging segment at M&A has more than doubled in the past 2 decades. So it's a growing segment for the reasons that Corey had mentioned. That's one. 2 is about 80% of packaging deals are strategically motivated. So there are about 20% of deals reflect private equity platforms, but 80% relate to either strategic deals or private equity bolt-ons. So there are strategic motivations in most deals. Number 3 is about 73% of deals have an international orientation. So there is a growing and increasing cross-border element to the M&A business today. Number 4, 82% of packaging companies have annual sales under 100 million. So it's a small and mid-cap industry. And 5 is that over 80% of the largest and strongest packaging converters had merged or sold over the past 2 decades. So with 80% of those having merged or sold, we're seeing the trend where this demand curve and the demand for add-ons is going toward the mid-cap and small-cap companies, increasing multiples in that sector and increasing demand for those companies. So that's what we're seeing across the board. There are some evolutionary trends in M&A, especially as it relates to private equity, as it relates to how does the pipeline look? What does deal quality look like? What are the market conditions looking like for next year? What makes for an attractive add-on or platform transaction? And how do you strategize portfolio exits and selling a portfolio or part of a portfolio company? So those are the 4 questions we'll get into. I think everybody's got a familiarity with these subjects, and so we're all keen to hear the latest and greatest from these 3 experts. But before we jump into these 4 questions, we'll spend about 5 minutes per question because we want to leave a little time for Q&A. But I don't know if Paul or Evan or Damon, if you want to jump in and maybe give a quick bio, that would be great.
I can jump in and go first. Good morning, everyone. I'm Damon Tommy. I'm a managing director here at Mason Wells, where I've been for about 12 years now. Mason Wells is a lower middle market private equity firm based in Milwaukee, Wisconsin. We focus on primarily Midwest-based family-owned businesses, and we're investing out of our 5th fund with about $770 million in that fund. So the most important thing for us is to be that first institutional capital in any given deal. So about 80% of the deals that we do are 2nd, 3rd, 4th generation family-owned businesses. Founder-owned businesses, corporate divestitures would round out the balance of the deals that we do. In the packaging space, we've been one of the most active investors in the packaging world for the past 20, 25 years. We've done 11 platform deals in the packaging materials and converting space. Across our 5 funds, we've done almost an equal number of add-on acquisitions at those portfolio companies. So over 20 packaging deals completed over the past 20 years. And that's really primarily been in the fiber and plastic-based materials and converting world for consumer and medical focused packaging businesses. So spent a lot of time in the space. I lead our efforts here at Mason Wells in the packaging sector. So happy to be here this morning.
Thanks, Damon.
Evan, you want to go? Oh. I'll tell you what, I'll go real quick, Tom. So I'm Paul Everett, operating partner with Longview Capital out of New Orleans. So I'll let Evan give background on Longview. I am an industry guy, so I spent 30 plus years mostly in blown film packaging. Some of those places I've been are Heritage Bag Company, also Pitt Plastics, and then most recently, just a couple years ago, was a few years ago rather, was Clendalkin, and we sold the Clendalkin assets to Novalex. Spent a couple years helping transition that, and for the last 4 years, I've been an operating partner working with the packaging team on our packaging investments at Longview Capital. Uh-oh. No
Yeah, but
sound?
I think Paul, I think Evan is dialing back in. But
Yeah.
in terms of your portfolio responsibilities, you've got Traco is a sleeve label company, I think, right? And you've got Summit.
Correct. Yeah. Traco would be labels, pouches, shrink sleeves, and Summit Packaging is another platform that we have. That platform is blown film. We've done a couple add-ons with that business to take us into printing and converting. Mostly a vertically integrated platform today, and we continue to grow that one. All right, while we're waiting on Evan, I'll give a little background real quickly on LVC. Longview Capital, very similar to Damon and Mason Wells. We're a lower middle market, fourth fund today, have about pushing $1 billion under management in total. Packaging is one of our many sectors, but certainly a focus area. And Tom, to your point, we've got those two platforms right now.
Excellent. I'm not sure, Evan, if you're able to hear us. I can give an introduction for Evan. We keep moving here, but Evan's up from New Orleans. He's a native of San Antonio, a dedicated and devoted Spurs fan, so he's not too happy right now. But Evan is an expert in the packaging space. He's working on Summit, Traco, and also PodPack, which does coffee pods and so forth, and a couple of other portfolio companies in other areas. But Evan is the resident expert at Longview from the execution side in packaging. I think Paul from the operating side is a Longview expert in packaging. So I'm not sure if Evan is back to add anything to that. Otherwise, we can move on and start going through the Q&A.
I can. We'll do old school here.
Yeah, I was trying to use the platform or join in through Paul, but I don't know what happened here. The second I get from backstage to on stage, the mic goes away. So we'll see if this can work. But Paul did a good job introducing us. We're a lower middle market private equity firm based in New Orleans. Similar to Damon and their strategy, we're focused on partnering with entrepreneurs, founders, family-owned businesses, and being that first institutional partner. I'd say Damon's certainly list of packaging investments exceeds ours. We've got 3 platforms and have subsequently executed about 5 add-ons in our portfolio. We remain active in the space. Paul is our operating partner that focuses exclusively on packaging, and I spend the majority of my time as well on packaging. But our investment criteria, which sounds, again, it's a very common theme in the industry, is how do we think about partnering with businesses, being that first institutional capital, looking to be more than just dollars being a strategic asset to any partnership. And so, again, apologies about the audio here. We'll see if I can do it through Paul and make this work.
Sounds good, Evan. So since we have you, Evan, why don't we start with the first question? Any observations on how the deal pipeline is now and what changes you've seen over the past few years? The M&A deal pipeline in packaging.
I don't know about Damon. We spend a lot of time just given our model on, having conversations directly with entrepreneurs, founders, talking and visiting with folks like yourself. I know this is a part of the topic, later on, but, increasingly, we're having, whether it's one-off or conversations or limited processes that happen over the course of time. So many of the conversations and partnerships that will evolve this year have been, relationships that we've been building over, many months, if not years. And so, from that standpoint, we are less in the ebbs and flows of kind of where the broader market is in terms of packaging activity that I think you see being brought to the market in terms of just broad auction processes. That said, we've seen a particular uptick here in the last few months, certainly ahead of summer. As I think, a lot of folks are getting back into the market, feeling more comfortable with, where their business is, where the trends are, and feeling on stable footing going into, a process or an auction.
Great, Damon. Any observations these days?
Yeah, and I'd echo Evan. I mean, we half the businesses in our portfolio were sourced on a proprietary, directly negotiated basis, where we developed a relationship with a business owner over many years. So we're continuously having those conversations and building those relationships. But in terms of the pipeline and activity, the reality is, I think it hasn't exactly been totally robust over the past 12 months, at least relative to the prior 12, 24, 36 months to that. It's been a little bit softer in the packaging space, and I think that that's reflective of some of the performance in the packaging space. The reality is, I think we're maybe 10 minutes into this, and we'll use the word for the first time, which I think will be said a few more times: destocking. Destocking hit the industry in late 22 and 2023. Which obviously made it tough for some companies to feel like they had the momentum to give them confidence to head out into the market. Certainly the case with a lot of the private equity-owned platforms out there, but even family-owned businesses out there feeling the effects of that. So I think that that's had a muted effect on M&A activity. But that being said, I think family-owned businesses have been and continue to be a little bit more willing to go out into the market than private equity-owned platforms. Add-on activity, I think, has been more robust than platform activity. We're certainly seeing that across our packaging platforms. So there's pockets, and I think that there's growing signs that things are going to pick up a little bit here as we go forward, but certainly still in a bit more of a muted environment relative to the past few years.
Yeah, Paul, any observations there?
Yeah, I would echo my colleagues' comments as well. I think too, I'd add, while things are picking back up, I think there's a little bit more work to be done in deals and conversations to be had to get to the right partnership. Some of the deals have a little bit more hair on them and possibly a little bit more challenging than they were in the past. But we like that because it helps us work to that right partnership, especially in the markets where we play. It's funny, David, your comments on destocking, and sometimes the destocking takes that same connotation as the COVID bump did. Nobody ever wanted to say, hey, that's not a COVID bump. We're killing it. Our business is going great. Similar with the destocking, it's not really going down. We're just seeing a little bump. We've been very fortunate in our own platforms, and hats off to our CEOs, where they've said, look, we're really not going to play destocking. We're going to just keep pushing. We're either growing or we're not. And we try to look at the deal market the same way. Good companies are growing, but there are a lot of bumps. And in respect to the destocking, there's a real part of it as well.
Yeah, I just jump in, and I mean, destocking has almost become the excuse du jour too. Yeah, right? Yeah. Whereas if you look at the underlying data, the reality is, volumes, at least for our, we do a lot in the food and beverage space, for instance, consumer space, our packaging businesses do. The underlying data isn't all that great either. It's not like grocery volumes have exploded this year. Volumes are still very much muted, coming off what it was a very heavy inflationary environment in the food and beverage world, right? So I think it's going to take some time to get some of that true volume growth back up and running. Now we're going to be entering this year where I think you're going to be having some easier comps against an even tougher 2023 period. So show some growth, and quite frankly, I think that's going to result in 2025 probably being a little bit more of an active period for us.
Yep. So, Damon, on that note, the destocking and so forth led to, I believe, people were referring to really a quality issue in terms of quality of deals in the pipeline in 2023. Has that improved? Is that improving in 24? And is that kind of what you're thinking, Damon, in terms of the quality of deals, improving in 24 and then being better in 25?
Yeah, I think you're right, Tom. There's been some situations where companies have come out because they've had to, right? A fund has needed to transact for fund dynamics rather than this being the perfect time to bring something out, or a family's needing to transact because of something going on in their personal lives rather than this being the perfect time to transact, right? So there's been some of those situations. And, Paul mentioned it earlier, we viewed a lot of that as opportunity rather than challenges, right? That's how we view some of those situations, as being able to help them get through some of these more difficult times and invest for the future is how we view those. But, look, I don't feel like we are going to see a seismic shift in the packaging M&A world here in 2024. Again, I do think that people are going to want to show some growth in 2024 over 2023, build that momentum as the underlying volume demand does pick up here, and build off of that as they think about taking their businesses out to market in 2025. Now, I'll say this, if you look at the performance of some of the big public companies out there in Q1, it was still pretty tough. Right. And I think that we saw a divergence in terms of the performance of our packaging businesses relative to those big public guys. And I think that that's an important dynamic. We want to be that service and design oriented alternative to our customers relative to the big public companies and very large private equity owned platforms out there. Right. And that's resulting in us getting a lot of new business wins at our packaging businesses over the past 6 months that are now ramping up here as we progress through 2024. So I think if you're a lower mid-market type packaging platform that has made the right investments in service, in design, in being that market-focused ally for your customers, you're probably seeing a lot better growth than the big public guys, and going to be pointing to a lot of growth as you exit 2024 and enter 2025. And that's going to give you a lot of confidence in bringing your business out to market.
Excellent. Yeah, I think we've got a good feeling for where things are headed in 24, 25, which is our second question. In the interest of time, let's move on to question number 3. That's what makes for an attractive platform acquisition or add-on acquisition? Do we want to start maybe with Paul on that one, since Paul's the operator?
Yeah, I can try to tackle that. I think it's got to fit within what we would call our guardrails, if you will. I mean, it's got to extend our capability somehow, extend our capacity somehow, extend our geography somehow. Ideally, the same sales force, and almost need to be the same sales force would sell the same product to the same group of customers, and everything fits. Culture is a big deal. Machines are easy. They're relatively easy. You unplug them, you plug them back in, they work, they don't work, but the culture has to fit as well. So I think if the capabilities, the markets, the teams, and the culture align, those are the big things that we're certainly looking for.
Yeah, Evan, David, any thoughts on add-ons versus platforms?
Well, every characteristic that Paul listed, I think you can interchange with, whether it's a platform or an add-on. I mean, whether it's a platform or an add-on largely is in the eyes of, the suitor, right? One business's platform is another's add-on. And so we look at it from a similar lens on both criteria. I mean, I think the differentiator for us is, for a platform, really obviously needs to be able to stand on its own 2 feet. We look really much more heavily at the existing team and infrastructure and make a decision on whether it's something that can be built upon, whether it's scalable, whether ultimately that underlying fit there is with that partner. Because with an add-on, typically we find that we're more flexible in terms of, owners' desires, transitions on, their ultimate timeline and time horizon involvement with a business. Versus a platform, we're really looking for a committed partner that's going to take it to the next level and want to be involved in the business. And again, it also just comes down to size, but that's all, again, in the eyes of the beholder. For us, a platform generally starts in that, $5 million-ish of profitability. Damon, that number may be higher for him. In other firms, it may be lower, right? And so, I think you got to flip the script and say, whether you want to be a platform or not on depends on your level of involvement, your comfort, and the team and the business you built around you, and whether or not it can be built upon, or whether it makes more sense perhaps to a larger organization. And a lot of that, I think, will be dictated by the interactions that a business has every day in the market, right? You kind of get a sense on whether you're pulling weight and you can do so across multiple facets of an organization, or whether or not you say, hey, I think my business actually would fit great as a key strategic component of this other business. But again, all in the eyes of the beholder, and so I think every situation is different.
David, any add-on thoughts there? Or?
Yeah, if you take a step back and just look at the, what makes a good packaging deal in our minds, as I said earlier, want to be that service and design oriented alternative to some of the big guys, right? So design and engineering capabilities are important for what we look for in our businesses. Raw material cost control. We all know, having gone through 2020 and 2021 and 2022, that if you can't manage your resin or your paperboard or whatever the case may be in an effective manner, it's going to be very painful at certain times. Uniquely positioned to take share in the market, on-brand materials. Those are some of the underlying characteristics that we want to see in some of our packaging businesses. And unique to us, we like some of that. I think Paul mentioned hair earlier. I'm not an expert in hair, but in our businesses, those undermanaged characteristics are really what we like, right? That opportunity to introduce process, to introduce accountability, to introduce metrics, to introduce a different strategy to go to market, whatever the case may be at these family-owned businesses. That's the kind of value that you want to bring as a partner at the end of the day to help take these businesses to the next level. And then lastly, in terms of add-on acquisitions, look, I been through a number of mergers in my 12 years here at Mason Wells. I think doing the right add-ons is more important than doing the right number of add-ons. I'd rather grow a business 2 or 3 times the right way rather than growing a business 5 or 6 times by just mashing a bunch of things together, quite frankly. And culture is certainly the number one aspect of that. You can have the best thesis on paper, but if the cultures don't fit, if the people don't fit, then it's all for naught at the end of the day, and it's going to be a bigger headache than it's worth. Somebody mentioned synergies. I mean, synergies are table stakes, right? It's got to be culture. It's got to be a strategic fit. It's got to be solving your collective customers' problems better together than separately.
Gotcha. And then I think we're running a little tight on time, but just one last any quick comments on the exit scenario in terms of exiting a portfolio company, either all or part of it, and the timing of that? Any thoughts on that in terms of strategies, guys?
I'm biased, but it's what we do under our ownership that's going to dictate how successful that business is in the market versus positioning or anything. Now, you got to hire a good investment banker, Tom, as you know quite well. But nonetheless, it's what we do during the 5 to 7 years under our ownership that is going to be most important to the market at the end of the day.
Great point. Evan, Paul, any?
Yeah, I can add. I think it's important to start having conversations with strategic advisors early on, well before you're interested in potentially exploring what an exit might look like for a new partnership. While positioning, I agree, Damon's right. People look through positioning pretty quickly, especially those with experience in the space. There are things that you can do for your business to, help put your best foot forward, right? And a lot of those things happen over the course of time. In terms of putting your best foot forward, you want to make sure you go into any process, and folks like Tom will tell you this, with the wind at your back, right? The second you get into active diligence with anyone, every single number is going to be scrutinized. And whether it's right or wrong, that's just the nature of the beast. And so, you want to be putting forward projections and numbers that you feel confident and can hit. And obviously you need to have the business behind it that will support it. Things come up and partners will be flexible, right? And tend to look through blips and one-offs, especially in the context of a true partnership and not just a toss the keys scenario. But again, it's nice to have the wind at your back. It makes the whole thing a lot easier for you.
Thank you. Yeah, I'm not sure if there's any other comments, or if we should go to questions if we have time, Corey and Tavir.
Yeah, we have a few questions from the audience, so we have time for that. Certainly it was a good discussion. Thanks, Thomas and Paul, Damon, and Evan. One of the questions we did get from the audience, I don't know if you can see it, Thomas, but it was what kind of multiples are deals going for now and projected for 2025? I think that's probably a question to ask anyone in today's program, but from your guys' perspectives, where are you seeing multiples this year, and how do you see that looking in 2025? Anyone else?
Yeah, Tom.
I'll jump in. Well, if there are any sellers on the line, I'd say multiples are about 5 times right now. Just kidding. No, I think the reality is the answer to that question is going to be so company specific that it's tough to give a very peanut butter, at least number or numbers. But what I can say is that, look, the reality is multiples have come down from where they were 3 years ago. So relative to where they've been in recent history, there's going to be a little bit of a haircut, right? For the general business, the A businesses, the A+ businesses are still seeing those very strong multiples out there, right? And that's what you always strive to build, is that strategic asset. But by and large, the average or the median company is going to be seeing a little bit lower multiples out there. But relative to longer history, those multiples are still very much up, right? So it's still a very good time to be in the packaging space, and to, especially if you are able to build one of those A or A+ assets out there.
Great.
And I'll add real quickly to that. I would agree. It's a really difficult thing to nail down, and it's very situation specific. But the one thing I would add is there's so much emphasis put on LTM. I mean, that's where everyone is going to pay attention, is the LTM. But I think the differential between the higher end multiples and average multiples are, where is the business going? Has it really been, back to your comments, Damon, has it been built for growth? Is it headed in the right direction? Is it ahead of the markets? And, the Wayne Gretzky quote, is it headed to where the puck is going, not to where it's already been? That's the differentiator in, good multiples versus great multiples.
Yeah, I think people get hung up and stuck on what's the multiple for the business today. I think we're seeing a lot of structures that are more creative, right? How do we think about the long-term value of the business and what the long-term value is for any given stakeholder? And so, we've put in place, and, I know folks like Damon did this too, pretty creative, structuring and incentive programs and, economic shifts whereby, you can align the partnership up front, allow you to put, a fair price, right, that maybe bridges the bid-ask spread on the front end, allows you to recoup that and more on the back end. When the ultimate day comes to, ideally find a new partner for your business. And, this will happen as your business gets bigger, the buyer universe gets different, and, tends to be as you move up from a 5 to a 10 to a 15 to a 20, in terms of profitability, your multiple is going to naturally expand as your buyer universe evolves. And so, that will happen. And we found a lot of success in having more true partnership like conversations. And, those that have been open to those, I think, you're going to see a lot of activity in terms of those that don't want to wait, right, for just the ultimate high dollar.
Great. Thomas, any input from you on regards to multiples?
Oh, thanks, Corey. You got the experts here, but I would just say I would just reflect what Damon said, is that it is case specific, and there's been a flight to quality. So those A assets still are getting high multiples, and those B might get close to it, but the C and D assets, that's very difficult now because of the flight to quality. So I think it's essentially what Damon was saying, but yeah, a little bit of a flight to quality. And then we'll see over the next year how the credit markets, improve, which I think makes it, I think add-ons might be a little easier since you have credit in place versus a platform deal. You got to, get new money, and that's always challenging depending on the deal size. So I think platform versus add-on is something to look at too. I think Corey versus on pricing, in terms of how much money you can raise on the platform side versus the add-on. You're pretty strategic, and you might have the cash to do the deal. So multiples might lean higher on the add-on side versus the platform side, even though maybe the add-ons would be smaller deals than the platforms. But yeah, flight to quality.
Okay, great. And there was one last question from our audience. It was regarding comment I think you made, Damon, about destocking, which certainly reinforced and reiterated my opening comments on destocking in the industry and some other industry trends and dynamics. And the question was more around, do you see that the destocking is completed and we're building up stock or getting back to normalization through this year to start 2025 at a good baseline, or is that destocking still happening throughout this year and it'll be delayed in terms of normalization moving forward in terms of filling the pipeline? Any quick comment on that?
Yeah, I can go. From what we've seen, and obviously we've followed this very closely, I think destocking is largely behind us, although I do think that there are pockets where it's still prevalent. Healthcare, I think, hit later. Healthcare destocking, I think, hit later than it did in food and beverage. So I think healthcare destocking is still going on, likely still will go on for the next quarter or so before that's largely behind that industry. Obviously, a little bit more of a conservative industry. They needed to build up those safety stocks a little bit more, given the dynamics over the past few years. It'll take a little bit more time for that to work its way through the system. A little bit in beverage, I would say, is maybe still working its way through the system. But other than those two pockets that are nearing the end, I'd say destocking is largely behind us at this point, based on what we're seeing.
Great, thanks. If there's no other comments on that, we can just reiterate that, Damon, based on the work that AWA does and tracking and monitoring the sector in terms of volumes and growth trends. So thanks for that. And with that, we'll bring this panel discussion to conclusion. I'd like to thank Evan, Paul, and Damon for participating, and of course, Thomas, thank you for moderating and pulling this panel together. Appreciate the contribution and the insights. Have a
Thanks,
good
everybody.
Rest of your day. Thanks. Bye. That brings us to our next part of today's program, looking at technologies to elevate your M&A deal success. And we're going to have a short presentation from the Chief Executive Officer of Mergerware, which is a software company that helps drive and execute M&A deals. Dharmida is an experienced M&A professional with a strong drive to transform businesses, improve organizational post-merger performance. He possesses a solid foundation in strategic management and global business practices with a proven track record of leading successful change initiatives and executing successful M&A deals. So I'm going to turn it over to Dharamita, who's going to share with us how you can use technology to elevate the success of M&A deals. Thank you.
Hi, good morning. I think you can hear us. You guys are able to hear me? Just give me 1 second. Okay. Okay, so what I'm going to talk here is how technology will elevate your M&A deal success. So I was just listening, prior how packaging industry have been evolving, and M&A deal, the deal pipelines are strong. I think we are looking at coming year and beyond. Here, my presentation is primarily to see that how this M&A deal will become more successful through technology. So my background have been in merger and acquisition. So I used to do a large deals for a French company for several years, and then I founded this company. So if you look at this typical what we are trying to achieve through M&A life cycle is how we can bring technology enabled with M&A practices and how AI can support that. So AI is just an enabler, but primarily what we are trying to explain here is if you look at the whole M&A process, starting from a screening, due diligence, and post-merger integration, as soon as we go through this process is quite time consuming. It takes a lot of time, and we always have a dedicated team within the company, but still, lots of time, there are lots of guesswork. We might not have enough information to, take decisions. And while I was doing M&A deal, I have come across some situation where I have to go and find the right, target, and I might not have enough data to validate that this is the right target. Same comes to due diligence and post-merger integration. Many deal I have seen that due diligence is completely done, and when I go through and figure out what had gone good, what is what we could do better, we realize that due diligence there are many important things are really missed out. Same applies for post-merger integration. So if you look at entire post-merger integration and starting from deal screening, we are trying to leverage technology so that we can support M&A teams. So now what we are doing is, if you look at find the right prospect, this is an important exercise. Even you are large company or mid-sized company or a smaller company, if you have to find the right prospect, this is a very tedious work. So what we are trying to leverage AI and get more information that enables you to take your decision. So what we are doing is, if you are M&A professional, we are empowering you to have this technology where you can go and do your specific level of search, go and figure out that which target is the best suitable for your company, what is the strategic fitment, then you can calculate lots of risk and see that which deal is out of 20 or 30 deals you are going through, you can really go and sort in number of deals you want to go through and look at. So what we are doing is we are utilizing more advanced analytics and artificial intelligence basically to identify what should be the target, and also look at lots of data. So not only the company financial, which is available in the market, but looking at market trend and looking at, what are the behavior analysis like culture, how we can go and define the culture fitment of the company. So AI is just, technology is just kind of enabler, but we are trying to wrap it with your, M&A skills. Similarly, if you look at due diligence support, so I know I have written some detail, like this slide will be with you, so you can go through. But my idea here to tell you that how to improve our due diligence process, how we can make sure that the person who is leading this exercise, he can do better job. So entire DD, if you look at, basically what we are trying to do is, through technology, we are defining the process, which is defined by corporate to make sure that every due diligence process takes lesser time. It have enough information to make sure that we close the deal. And then all your document management, intelligence, what we are building. So suppose if I'm a legal guy, I might have, thousands of documents where it could be a litigation term. Now, what we are trying to bring AI is just make sure that we get summary of just one-pager summary of all litigation across coming from 5-6 different countries where DD team have worked. So we are trying to see that how we can empower this person who is doing DD so that he can do better job. So technology is one which we are supporting here. Similarly, virtual data room, if you have used, right? So this is also AI empowered, right? Contract analysis, your data visualization. So these all are supporting your day-by-day activity. Saving time through DD with more accuracy. So what we are doing is we are trying to reduce your time and also provide you accurate, outcome. So that we do through due diligence, communication and collaboration. So one of the biggest challenge what I have seen while I was making deal is most of the time deals are cross-border and our teams are sitting across, border. Also, there are team from the acquired company plus acquired the company which is buying another company. Communication becomes very key. How to make sure these communications are very timely communicated, and they are very critical part of the M&A deal success. So we are trying to bring technology there as well, apart from the process. So maybe we have built the process for change management, but how to make sure this change management process are being enabled and monitor that communication goes to every stakeholder. So we are we have a model where we are trying to help deal makers to make sure that all communications are stored and everybody is aware. Of course, video conferencing and instant messaging. So these all are part of your communication and collaboration, but we are trying to see how we can enable. So if during COVID time, you might have seen many of the DD we are able to do remotely, right? So that was possible through technology. Now we are going one step forward where you cannot replace human, right? If you are doing DD, you would like to meet the company to whom executive team to whom you want to acquire. So for them, we are trying to build some platform where we can go and really meet them. Once we come back, most of the information can be done remotely through technology. Then cyber security and risk assessment. So if you look at, there are lots of, we have, our legal team, they do lots of work towards looking at the contract monitoring, the cyber, the IP. Now what we are trying to do is through technology, we are trying to make sure this all processes are built within the platform and also given to people to go and monitor that. What are the cyber threat? Getting all the data in a nutshell. Like suppose if there is a DD which is done and there is some cyber security risk in this target company, you are able to get those information early so that you can take your decisions. So basically safeguarding data integrity and confidential information throughout the whole M&A process. What we are trying to achieve here is basically reduce the risk of M&A. Now, if you look at in conclusion, what we are trying to do is technology we don't consider as just software because it is a catalyst which is driving transformational change in M&A landscape. What it means that we are not replacing humans, right? We want to make sure that M&A expertise is very difficult, right? No AI can replace. But what we are trying to do is we work very hard. Like I was deal maker myself. I spend a lot of my time chasing people to make sure they are able to accomplish the activity. Suppose you do day one planning, making sure that all stream, all the people from different departments, they work together and deliver. That was nightmare. What we are doing is I don't have to chase now. If I'm using technology, I can go to my dashboard, I can see all the information. So we are trying to leverage technology in this area. Also, if you look at innovation and mitigating risk, there are a lot of things. Many times I have seen that we go and define M&A process within the company, but following those process and making sure the team is really going and very genuinely looking at those information is very rare. Same for knowledge management. So any organization, if you go, they have lots of knowledge management, lots of know-how they have learned through M&A deals, but they don't really use that. So how we can reuse those information for our further deals? So that also we try to solve through, M&A technology platform. Human cannot be kept out of M&A in spite of AI ML. So we tried all. We know human can be replaced, and that skills embedded with M&A skills. I think they make really technology can support your M&A. So these are the three top conclusions I have why technology is a good enabler for M&A. Just one slide just for you to know what we do. So basically what we are doing is we are putting all the process in technology platform for end-to-end deal management software. That helps you to make sure that your process are consistent across company. So, my first job when I took the role of M&A head, the biggest challenge is I don't know where to start because there is no standard process. Everybody is using their own way of doing M&A. So that process I build, and that's how I realized that those processes are very important to make sure that we don't really whenever we are doing DD or any M&A life cycle, we are very focused to have the deal objective in the mind. So that we do, and that's it. So we are based out of Boston, but we have offices around the world, and that's what we help company to do M&A deals. If you have any questions, I'll be happy to answer.
If there's any questions for, please provide them in the chat. We'd be happy to answer any questions before we take a short break to stretch our legs and get a cup of coffee or a beverage. Thank you for the short presentation. Appreciate the information. And with that, I don't think we have any questions. We're going to take a short break in 5 minutes. At 5 after the hour, we'll resume the last half of today's program, hearing from Stuart Sanford from Mizone & Associates on the global M&A trends in packaging. And then that will be followed by a very interesting roundtable discussion on navigating the cross-border M&A transactions and what are some of the challenges and opportunities in the current environment, particularly as it pertains to cross-border M&A transactions. So you can send any questions to our last speaker in the email provided in the chat, but would like to welcome everyone back in 5 minutes, 5 after the hour, to join us for the rest of today's program. Thank you. Hi, welcome back. Hope everyone had a quick chance to grab a cup of coffee or another beverage and stretch your legs. Welcome back for the second half of today's program. And it's a pleasure to introduce our next presenter, who's also going to moderate and lead a panel discussion on navigating cross-border M&A transactions, a review of challenges, opportunities, and the current environment. But first, diving into the next part of today's program, Stuart Sanford, the director of Maison and Associates, will give us a short presentation on diving into global M&A trends in the packaging sector. Stuart is the M&A leading advisor to clients around the globe on transactions and across a wide range of industries, including industrials and packaging, specialty materials, plastics, and other industry sectors. He has a broad background and experience with international M&A transactions as well as capital markets. So it's a pleasure to see you again, Stuart, virtually, and thank you for the time, and look forward to your comments on the current trends in M&A activity across the packaging sector, and then joining your panelists on discussing cross-border M&A transactions. So I'll turn over the stage to you and look forward to the presentation and the conversation. Thank you.
Thanks, Corey. Can everybody hear me okay? I hope so. Well, Corey, thank you again for offering to have us present at your conference. And as a little bit of background, as again Corey shared, we're an investment bank. I'm a director here at Maison Associates, representing clients in the middle market across sell side, buy side, in financing transactions. We've represented clients across Europe, or North America, Europe, and as well as Asia, and helping them traverse the transaction environment. And what I'll plan to do is share a little bit of backdrop of some data and some information in anticipation of our panel here in a few minutes. And so given the short amount of time, I'll go ahead and look to share my screen with the audience here. And so hopefully everybody can see my screen here. It looks like it is popping up. So again, so what I'd like to do is again set the stage. And so we'll talk a little bit about the general M&A environment and some cross-border dynamics that we've seen here recently, which we'll talk about further on the panel. So in a short amount of time, we'll look to breeze through some of the data points here. So high level, what we've been seeing in the market is, relatively tepid activity in the M&A market. We had a good amount of activity in 21 and in 2022, and so it's fallen off a peak, and valuations have also come down. I saw or heard the earlier questions around that, and keep in mind this data is aggregated across multiple packaging substrates, but in general, if you look at the general trends, activity has come down. And valuations have started to come down. Now, we'll talk about some other dynamics where we're seeing some of the trends go the other way here in the early stages of 2024. And so as we talk about what's impacted valuations, I think one of the big components, and you see, has impacted private equity. Just some data that looks across all industries, so not just specifically to packaging. As you saw, interest rates rise. Lenders start to retreat from the markets. You started to see valuations come down. What that has done from a cross-border or strategic buyer perspective has lended them sort of more confidence in pursuing transactions, and has ended up showing that they have participated and closed a larger proportion of overall M&A deals. And in general, one general data point too that is shown here is that lenders have, as a percentage of the overall enterprise value, they've been the most conservative that they've been in the last 10 years with some of the debt capital markets dynamics. But as we look forward here in 2024, we have started to see the banks start to re-enter the market, as well as private credit see competition from traditional senior bank lenders. Lending costs have started to come down, and we started to see this in early January and earlier this year in January, as well as in February 2024. This has caused basis points in general going to come down about 75 to 100 basis points, and a more robust financing market, albeit not as aggressive as 21 and early 22, would be a positive sign of cost of capital starting to slowly decline from much more elevated levels and support transactions for both strategic and private equity buyers. And as we think about, as an earlier comment about how the lending market has impacted private equity and valuations in general in the overall market, this is some data showing about demonstrating the buyer makeup year over year. And as you can see, private equity, during the lower cost environment and aggressive debt capital markets in 21, saw a huge pickup in both add-ons and platforms, and which has fallen off a decent amount by the time we hit 2023. But what's interesting is that corporate and private buyers, both domestically and overseas, actually had done more deals in 22 and 23 versus what was done in 21. So sort of bucking the trend of the general transaction volume, and that they're taking a bigger piece of the overall M&A pie. We'll talk a little bit about nearshoring as we go through the panel here in a few minutes, but thought it'd be useful to share some of this data. A few things that we've been talking about internally and with clients is some of their motivations of coming, say, to North America or from Europe or vice versa has been some of their customers looking to either bring them here over into North America or over into Europe, and thus their interest in doing M&A overseas, and to help substantiate the returns that they're looking for in an acquisition. We're also seeing just underlying commercial dynamics, push nearshoring initiatives for packaging companies, where their end customers are more coming to them versus seeking a supplier from China or otherwise in Asia. So overall, we've seen Mexico surpass China as the #1 exporter of goods in the U.S. And there continues to be a customer base that's looking to de-risk their sourcing of supplies from China and other countries that have been at risk in the supply chain. One other dynamic that we're seeing in the market is carve-outs are becoming more on trend more recently. And if you're an overseas buyer or a potential seller of a carve-out or a division of your company, this has become, as a buyer, this can be a pretty unique and accretive fashion to gain capacity in a new market, as well as an employee base to help satisfy customer needs, as well as satisfy your geography objectives. And then this is some of the data that we pulled for some of the cross-border and cross-regional activity. Cross-regional defined as sort of between North America, EMEA, and rest of the world, and cross-border, obviously cross country lines. Overall, what you see across the markets is that EMEA and rest of the world, actually a majority of the transactions are cross-border or cross-regional. North America has a pretty robust buyer universe, so it's cross-border and cross-regional buyers are smaller, but still represent 16% of the overall buyer population of M&A deals. And we continue to see and hear inquiries from overseas operators looking to get into the U.S. or into North America, as generally there's a sense of although I think every country has some sort of internal perceived risk, I think a lot of outsiders see the U.S. as being relatively stable and a friendly business environment. So, I think it's important, as we talked about as I mentioned, some of the other dynamics with, the overall changing winds, as you will, to consider, not just your domestic strategics, but also your overseas potential partners, if you're looking to execute an M&A transaction. And in general, we put some trends over here and changes year over year. I'd say the cross-regional, cross-border activity has been relatively stable year over year in comparison to the overall M&A volume. So as we saw M&A volumes come down, on a geography basis, they were relatively similar to what we saw in each geography. For instance, EMEA had obviously some of the geopolitical dynamics with Russia's invasion of Ukraine, and thus, year-over-year numbers were relatively flat, as 2022 was pretty muted. And then finally, we'll have a few panelists represented as part of the companies that are shown here. But as you can see, there's a pretty robust universe of strategic players out there that are, whether they're in labels or in packaging, that are that have executed cross-regional, not just cross-border initiatives. And the rationale behind those will vary. But what's interesting is that you see a good amount of groups not just focusing on one new geography. I think about 2/3 of these groups you can see played in multiple new geographies over time, and you can see it again, consistently across labels and flexibles operators. I will say you tend to see more of this type of activity in certain segments that tend to be more global in nature, versus maybe more, you do see some converters on the label side, but you see other suppliers and things like that are looking to go more global. And there's other ways, and we'll also have Virag from EPAC on our panel, and we'll talk a little bit about how to explore other alternatives to M&A to grow your business outside of your current geography, and what might be some other approaches to executing your strategy. So with that, I know I'm running a little bit over time. Hopefully that was useful for everybody in the audience, and hopefully that helps set the stage for our conversation with our panelists here. Awesome. All right. Well, thanks for the smooth transition, tech team here. Virag, Roberto, Danny, Max, can you all hear me okay? Nod your head. Cool. Awesome. Well, great. Well, hopefully that helps set the stage a little bit. And as I mentioned earlier, we've assembled an awesome crew of operators, executives, and advisors who have experience running operations around the globe and doing transactions, around the globe as well. And look forward to sharing or having them share a few of their insights. And we'll have a little bit of a Q&A session here to do that. And we'll talk about some of the topics I just covered. With that, I'd ask, maybe Virag, if you don't mind introducing yourself a little bit on your company, as well as, some of your experience, in background, that would be useful. And maybe you'll turn it over to Danny and Max, and then Gilberto.
Sounds good. Thanks, Stuart. Virag Patel here, co-founder, CEO of EPAC. Packaging industry for about 25 years, primarily through private equity firms that bought and acquired a lot of companies. With EPAC, we slightly changed the model for us. We thought, kind of creating a very uniform structure around how we build up our sites was more important than acquiring, because as you guys all probably know, acquisitions come with a lot of integration-related complexity. We wanted to build our plants from the ground up. So about 8 years ago, we founded EPAC, myself and two co-founders, and effectively built 25 different startups, 25 sites across the globe that are all part of our EPAC network, which I can explain a bit more later. So, and thanks for having me, Stuart.
Absolutely.
I think I'm supposed to go next. Hi, I'm Danny Alouche. I lead strategy, corp dev, and ventures for Avery Dennison. Avery Dennison is a large global material science company. The founder invented the pressure-sensitive adhesives, and from there, the company expanded over the years. Today, we have two main business units. One is the materials group, which kind of hosts in it the base material business that we make for labels. We also have some of our tapes business there, and then we have what we call a solutions group, which is are more of our kind of converting parts of the business, which we do specifically on apparel, where we convert price tickets and tags and things like that. And then we have our RFID business in that business, and we also acquired a large a company called Vestcom, which is the leading player in the U.S. for price at the shelf. When you go to grocery stores and you see buy one get one free, that's kind of what they do. So that's who we are. I've been at Avery for 14 years. And I think I'll leave it at that.
All right, Max.
Yeah, sure. Max Bauman. I've been with ProAmpac for 12 years now. ProAmpac is, for anyone in the industry, has been quite aggressive when it comes to acquisitions over the last decade and a half. So I've been able to experience most of that growth. There's about maybe close to 30 acquisitions at this point that, from an integration standpoint or from an acquisition standpoint, I've taken part in. ProAmpac, for those who don't know, we're largely in North America and Europe. We operate about 52 sites, flexible and paper packaging. We lean very heavily into material science, and we look to solve challenges around sustainability and next-gen packaging solutions. So we operate in a lot of markets, geography-wise, but also food, non-food, pet food. We're pretty versatile, pretty broad in terms of the markets that we go after and markets we go after. So happy to be here with the panel. Thanks for inviting me on, Stuart.
Absolutely. Alberto?
Hi, good morning. I'm Gilberto Sotelo, a founder and managing director of Alea Capital. We are an investment banking firm based in Mexico. We focus on the middle market in Mexico. We're pretty broad in terms of the industries that we cover. We have experience in industrials, in retail, in consumer products, which are relevant for today's discussion. Before that, I spent 17 years in investment banking with JP Morgan and Bank of America Merrill Lynch, both in Mexico and in New York. And pretty happy to be part of this panel. Thank you.
Awesome. Thanks everybody for introducing yourselves, and with that, maybe we'll kick off some of the Q&A that I'll ask the panelists to share some of their perspectives on. So Danny, maybe I'll start with you. We just shared a little bit of data on how some of the interest rate environment and debt capital markets and commercial softness has impacted the private, in the M&A world. It'd be useful to kind of hear a little bit of your perspectives of, how is that, as you think about, how have you been thinking about your capital allocation and long-term strategy, given, some of the dynamics that we've seen in the private M&A market versus, maybe what you've seen in the public markets?
Yeah, so I think you've covered the kind of the key element or the key underlying root cause for some of the changes, which is the increase of cost of capital. And for us, what we are seeing, not sure it's true for everybody, but what we're seeing is really still, for the first period of time, there was kind of very low level of activity. Private equity were basically shut out of the market. They didn't really do anything because they couldn't get even capital to use from debt markets. And then things have opened up, but still there is a pretty significant, I would say, bid-ask spread from as buyers, us included, kind of looking at our hurdle rates, which have gone up given the cost of capital have increased. The seller market, I think, is still expecting similar multiples. And I actually think that there is an interesting dynamic going on, which is the public markets that are continuing to go up and multiples continue to expand. Doesn't kind of help that bid-ask spread, because I think people on the seller side looking at it saying, well, look at what happened on the public markets, multiples there expand. why should our multiple kind of contract, if we were to sell something? And for us, it's to be frank, it's a little bit of a challenge kind of finding that place where we feel from a valuation perspective there is a match. So that I would say kind of the biggest change in dynamic for us as we look at the market. It doesn't really change the way we think about capital allocation. We've always been looking at capital allocation across multiple elements. We can buy back our shares, which is an investment in its own right. We can invest in our business and generate return on this. And we also have a dividend policy, so we issue dividend to our shareholders, and that's a way of returning cash to our shareholders. And then we have M&A, and for us, we haven't that kind of framework of how we think about it hasn't changed. It's just that the hurdle rates for everything kind of went up a little bit. So yeah, that's the biggest difference for us, the biggest evolution for us.
Are there any different themes that you've been focusing on, kind of given some of those dynamics like sustainability, certain solutions in different segments of your business, or certain themes that you've shifted gears towards as part of your long-term strategy?
Yeah, so there has been, and we have not necessarily related to kind of the capital market dynamics, but generally speaking, from our perspective, clearly sustainability is a big topic. We are, as a label manufacturer, we're clearly exposed to some of the sustainability trends, and some of them could be a risk to us, and others could be opportunity, or we can even turn some of those risks to opportunity. That's what kind of a little bit what we're trying to do. To be frank, on a sustainability standpoint, what we're doing is a couple of things. One is every acquisition we look at, we actually have a lens now of sustainability. How does it help or hurt our sustainability kind of agenda going forward, as well as how is the business positioned relative to the sustainability trends that we're seeing. The second thing we're doing there is we're spending a lot of time on our venture investment. We have a relatively small venture kind of fund. It's off our balance sheet, so it's not really a fund, standalone fund, but we're investing from our balance sheet. And so we're spending a lot more time from our venture program looking at potential sustainability kind of technologies, whether it's material science, or also kind of digital technologies to enable some of the sustainability and circularity trend. So that's kind of what we're doing in sustainability. The other element that we're really spending a lot more time on, and this is the evolution of what I would call turning dumb labels to smart labels. I think there's a lot of news around kind of smart labels, smart packages, smart supply chains. We have a very large business in RFID, which is we call kind of it's an intelligent label platform. We believe that at the end, every item will have a digital identity, and we think that we are well positioned in kind of playing in this intersection of physical and digital, and can make a connection from the physical item to the digital cloud, and their use cases and creating kind of use case values to customers from that point. And so we're spending a lot more time in that world of how do we enable more of these products to become intelligent through the label mechanism or the packaging. And I think you've kind of, some of you might have heard of the Walmart mandate around, kind of making sure that RFID gets into many of their items, kind of not just apparel, which they start with, but also kind of broader general retail. And I think if there are any converters on the line, I think it's going to be a big opportunity for the converters. And we're working hard on kind of trying to make sure that we can, we're helping those converters get enabled to be able to serve that need. So those are kind of, and clearly from an M&A perspective, this is also, a significant area of focus for us. What do we need to do in order to enable that more digital world in the future? So.
Thanks, Danny. Yeah, that's insightful. Maybe we'll shift gears a little bit to the flexible side and turn to Max here. What have you been seeing in the market? I mean, have you seen Proampac and other strategics kind of have a leg up on private equity, or and as you kind of think about the recent market, have you seen some there are common pitfalls of getting deals done in this market, and is that kind of being more seen in Europe versus North America? So I layered you with a few questions there, but I'll let you run with it.
Yeah, sure. No, thank you. From Proampac's perspective, we're obviously still very active in the market. We have seen some non-strategics back out of processes, especially for deals that might be more platform type acquisitions, or strategic acquisitions, historically they would have pressed on. But for those acquisitions where synergies are minimal, we are seeing some non-strategic start to back out. Some of the reasons I think we've already discussed a little bit, and we'll talk about more of those as we go. But from our view, as long as there's strong business fundamentals and there's a solid operating culture and environment, then from our standpoint, we're still able to figure out the economics fairly quickly and make transactions happen. So we're still being very active. We are seeing some non-strategics back out where historically maybe they wouldn't. You asked about pitfalls. We've talked about the bid-ask spread, and that's absolutely something that a primary theme that we're seeing across deals that we're looking at as well. The other one we haven't touched on yet is underinvested companies that just maybe the bid-ask spread is there, but the cash aspect of the deal just isn't quite favorable because of just how underinvested the business has been historically. You've got to be competitive in the marketplace, right? We want to invest in good companies with good equipment and some capacity and runway for growth. So if that's not there, sometimes the cash draw can just be too much, and we'll walk away for that reason. I think related to the bid-ask spread, I think one of the key things, and the spread can be there for a few reasons, but one of the common, I guess, themes we're seeing is underlying business performance starts to erode, but the price of the business remaining the same from the seller standpoint. So that's really a big theme that we're seeing. It feels weird to talk about it this way, but I think because we've been out of the pandemic for so long, and I think so many people want to be done talking about that. And I think we're close, but I think what we're seeing is that we're just not quite out of the woodwork yet. If you go back 5 years or more, at the start of, I guess about 5 years ago almost now, we saw a lot of supply demand gyrations really happening within the sector as a result of the response to the pandemic. That was the first wave. And then you had, from there, you saw a lot of raw material inflation and allocations come through. And then it was timing of inventory roll-offs. And then now we're seeing more shifts in consumer spending habits as inflation really takes hold on the back of government stimulus programs from the pandemic rolling off. Some of them just rolling off as recently as last year, at least in the US. So you're seeing this compounding effect that's still going through. I do think some of that's related to the pandemic. I know we're not talking about that as much anymore, but as that happens, I think what you're finding is businesses that 6 or 12 months ago thought they would have found their new baseline coming out of all of these dynamics I just mentioned. They're finding that they have additional volume challenges that they need to go address in their business in order to get the number that they want when they go to sell the business. So I think that's kind of what's driving a little bit of the bid-ask spread. Just it's not the only theme, but it's definitely a key theme that we've been able to kind of trend as we look at a bunch of deals over the past year or so.
Thanks, Max. Maybe we'll shift over to Virag a little bit and talk about, I understand that you've taken a more sort of partnership approach or a different, call it different or a partnership approach to expanding your operations, not just here in the U.S., but also over in Europe and I think even you might have a location over in Africa too as well. So love to kind of hear a little bit of how, if you could share what you can on sort of how you kind of went about doing that and maybe some of the pros and cons about going about it that way versus maybe the traditional M&A path.
Yeah, I'm happy to. I think some of the panelists talked about some of the challenges in this market today with M&A. I think we were trying to avoid a lot of that. Like I said, I spent 20 years before that in M&A activities. So finding good deals was always a challenge, and finding companies that culturally were like-minded and similar was also a challenge. So we just started. Our concept was build out greenfields, and we've done that all around the world in the same model. And the reason I think we can do that and scale, it's because they're pretty simple. Each plant is I call it a plant in the box. It's a small footprint, so you don't need a lot of space to find these locations. We're primarily built around urban areas or cities, which means flex spaces are pretty readily available. Labor generally is readily available as well, and the model itself is is cookie cutter, right? So the machines that we put in North America are the same machines we would put in Africa or Indonesia or Melbourne or anywhere else. So, and these are all global vendors and partners. So I think that ability to scale on a simple model allowed us to, to scale and replicate easier. And we can still do that, I think, today relatively easily. The hardest part of that wasn't the equipment, it's really the software and the integration of the workflow. We have tons of customers. And if you go to a new market and to lead gen those new customers into our ecosystem takes time. And then once they're in our ecosystem, the workflow of getting them from quote to production, that all has been pretty well developed. And it's the same model we would use anywhere in the world. So I think you can, we don't have a challenge with that, I guess I'd say, as far as scaling. Now, I think the challenge is what I would see is our customers, because the cost of capital has gotten so excessive, their ability to scale, which means our volumes in these newer markets are slower picking up than we would have seen 3 years ago, 4 years ago. So building out a 3-year model for a new plant requires us a little bit more padding and risk assessment than it would have a few years ago. A few years ago, you could build and the customers would almost show up. Now you have to be a bit more tactical around how you look at the markets that we're servicing. So, but yeah, I think scaling it's still pretty quick. We do have a build out team that goes out globally and finds those sites. It's step and repeat with the vendors. So that hasn't been too much of a challenge, I think, for us right now.
Okay.
Yeah.
And then just one quick thing, as you mentioned, you're using your own software. As you kind of go back to your old days, is that some of the pros around it where you're not having to backward integrate into your software? You're sort of starting from scratch. Is that one of the make it easier things of your expansion strategy?
Yeah, for sure. I think the pros for us, it's by doing it this way, it's been, again, time to market. Standardization allows us to problem solve very quickly, whether it's in software and we find an issue in our workflow. When we actually solve it, it's very easy to deploy across the 25 sites. But I think it also makes the ability for us to train, ramp people up in new markets a bit easier. We use a lot of learning systems, a lot of visual and video tools in remote places to allow people to learn and integrate. And you can only do that, I think, with the standardization. If you've got one-off sites, it's a bit harder. You got to be there on site for 4 to 6 weeks. And we didn't have to do that. We built half of our fleet during COVID, but we couldn't travel. So I think that kind of is a good testament to the way we scaled up.
Okay. Well, I'll try and keep moving here. Gilberto, you probably bring a unique lens in sort of the Mexico, Latin America, and South America market. If you could just sort of touch down kind of what there's been a lot of talk about nearshoring and what have you seen boots on the ground from an inbound and outbound cross-border perspective? And what is a lot of individuals on this in this conference might not be familiar. What are the attributes of doing M&A and sort of the credit markets in Mexico that might vary from than what you might see in the U.S. and Europe, if any?
Sure. Well, I think M&A activity has weakened as it has happened in other parts of the world, including North America, specifically the U.S. It's beginning to show signs of potentially picking up this year and in the coming years. Nearshoring is clearly an important factor. Clearly, investors in the nearshoring space have been preparing for this nearshoring story as it develops. For example, in 2022, there were 5 transactions in the consumer products manufacturing space. The majority of them by international investors, basically seeing nearshoring as something very strategic and focusing their transactions on that. There were 33 transactions in that space in 2023, and there have been 3 transactions so far this year in consumer products and manufacturing, M&A transactions. In consumer products retail transactions, there were 10 transactions in 2022 most of them by international investors focusing on nearshoring, and one transaction only in 2023 as the market was down. In packaging, 2023 was pretty active, 6 transactions last year by many of the international players who are very well known by the majority of you. So clearly, nearshoring is something that investors have on their minds, and they're preparing for that. There's a lot of potential future activity in Mexico as Mexico develops its infrastructure to be a better fit for the nearshoring situation. For example, China had between 20 and 25 years to basically slowly or quickly develop their infrastructure, which is not only related to providing the background for manufacturing infrastructure, but everything that goes around it, education, logistics, etc. A lot of that still needs to be developed in Mexico, and that provides plenty of opportunities for international capital to be part of that, as well as local capital. What investors are seeing is not only the nearshoring opportunity, but they're also seeing stability in the country. Interest rates have been high, as in the majority of the countries in the world, but they are bound to come down as inflation has been under control, and a strong peso. We just had an election this past weekend, which is very, very relevant, and something that we will need to follow over the coming days and weeks to see how that develops. There was a landslide victory by the ruling party, Morena, who has been in some areas pro-business. They have definitely been pro free trade agreement and pro nearshoring, but in other areas, such as in the energy sector, which is very relevant for nearshoring, they have been against private participation, and that is a factor that needs to be considered going forward. They were able, apparently, final results are not out yet, but there's a high probability that they are able to take both Congress and the Senate, which would give them an opportunity to implement potentially constitutional changes. And we need to see whether those changes actually happen, whether they are positive for nearshoring and the country going forward, etc. But investors continue to see a diversified economy with a labor market that is well trained, that has a tradition in manufacturing, and obviously the geographic situation of Mexico is very favorable, and people are taking that clearly into account as they build their strategy going forward. In terms of private equity, private debt, we have seen, and even strategic players in Mexico, we have seen them preparing for nearshoring. There are private equity funds that are beginning to raise funding to provide capital for nearshoring with that specific focus. And there are also companies such as the largest REIT in Mexico, Fibra Uno, that is separating or has separated its industrial assets to have a very specific, for those industrial assets to have a very specific focus and strategy on nearshoring. So clearly the ecosystem is beginning to prepare for that to continue developing. Obviously, we need to follow very closely what happens on the political front and how that impacts the nearshoring situation. And we cannot avoid looking at the elections in the US by the end of the year, which could potentially also have an impact in terms of the free trade agreement and and potentially as a result of that on nearshoring. But I remain optimistic that nearshoring is something that needs to happen, that is natural for it to happen, and companies clearly are looking across the cycle, across U.S. elections, across political situations and elections in Mexico, as they have done in the past. They look at these kinds of things across the cycle and try to participate through investments in M&A in the sector.
Yep. Well, I know Corey's gonna we're gonna have a hard cutoff here soon, so maybe we'll try and shift gears. And thank you for everybody for those responses. I guess I'll try and ask a few questions here, and if you don't mind, we'll try and jump through a few other topics. And I saw some questions here that we'll see if we have some time to cover, and if we don't, I'm happy to answer those after the panel discussion. Max, maybe quickly just touch on, you mentioned some things you're talking about later, maybe just quickly kind of the pre-post diligence value creation action list with all the things we've been talking about, maybe just a few anecdotes of kind of recent years. How's that been impacted recently? How has that evolved? If you can kind of give us 2 or 3 things quickly that you would share, that'd be appreciated.
Yeah, of course. Priorities of the business have obviously evolved over the past few years. Price and margin controls, focus on automation, attention to volume trends. That's already come up a couple of times just in the panel discussion. So by default, our action planning list for any of our diligence or post deal integrations, that's evolved. And all those items, they've always been on those lists. They're just being prioritized more now. Just to pick on volume for an example, historically, CAGRs for volume and revenue were fairly similar, but that's not the case anymore. So that's one area where we're asking for more information during diligence, and then we're having a much tighter focus right out of the gate, starting on day 1 of integration. So there's just a couple for you, Stuart.
No, thank you. Virag, maybe just touch down briefly. Are there certain markets where you found or just cultural dynamics that you feel like have been, challenges that you've overcome as you enter in certain markets, whether even in the U.S., we have certain areas that have different cultures. You maybe just share a little bit of how you kind of go about doing that, and maybe some lessons for the crowd.
Sure. Yeah, I mean, like I said, we have a pretty cookie cutter model, but I think the cons of that being is our ability to be elastic to customer requests, specifically in countries, is a bit challenging, right? We don't produce something custom for a particular area, so we had to adapt in like Indonesia and Ghana and some of these places where a good example is like how they interface with us is really through WhatsApp. Customers will interface, put POs in, payment processing happens through WhatsApp messaging systems. And so you have to integrate that into our workflow somewhere. And that took time. It took almost 2 years to be able to do that, where, maybe it would have taken somebody else a lot less, because it has to work within our ecosystem. So it's not easy. I mean, operating equipment, specs, building, and all those things, procurement, and all that's pretty straightforward. But how our customers want to be interacting with us is it's different in different markets. Some of them are more sophisticated, some of them are less. So.
Okay. Yeah, got it. Danny, maybe moving on, there's a question in the chat here about sustainability. You brought that up. Maybe we'll just shift to that if that's okay. And kind of as how do you, I think the question here is sort of, what sustainability metrics are you valuing in acquisitions, and has that kind of changed depending on North America or Europe? Any insights that you can share?
Yeah. So I think generally speaking, clearly Europe is ahead of North America and ahead of the rest of the world. But given that we are a buyer that buys to own forever, quote unquote, I mean, we believe that over time things will migrate to the same thing. So maybe Europe will lead, but North America will come after. There are elements that Asia is actually ahead, and so we're not looking at it by geography from that standpoint, but clearly Europe is leading. The things we are looking at is from a kind of and it's less of a kind of objective metrics, a little bit more of subjective, is really are those, whatever we're, the assets or whatever the business is, does it increase the circular economy? Does it create more waste? Does it does the way they make their products, is it in a sustainable way or not? So there's kind of an internal greenhouse gas emission type of element. There's an element of product and solutions. Are their product solutions sustainable? And are they enabling circularity? Are they going to help us drive more circularity to in our products and solutions? And so those are kind of the elements we're looking at. And again, it's less about hard objective metrics like numbers. It's more about our team's assessment of how these will help us from going forward. The greenhouse gas emission, all these kind of things are a little bit more objective, I would say.
Okay, got it. No, thanks for that. Gilberto, maybe just kind of revisiting kind of your perspectives on Mexico, just from a deal execution perspective. Is it? Do you find the market to be relatively similar from a let's just say from a transaction process perspective, and from a credit markets, is it a market where, for those interested in entering that market, is it widely supported by senior banks, or is it primarily and private credit, or is it just private credit?
Yeah, it's well, the credit markets are obviously shallower in Mexico than in the US, but clearly the banks are open. The banks are participating in transactions. They are open to finance acquisitions. Private debt is also active. Interestingly, as of last week, before the elections, I've noticed tremendous interest by private debt and private equity investors calling us up to see whether there were opportunities to participate in Mexico. So there continues to be a focus by private debt and private equity investors from the US. The private equity investment environment is pretty shallow in Mexico. So is private debt, but banks are open to participate. In terms of comparisons in against the US, due diligence is perhaps perhaps deeper than in the US. People are being extra careful in terms of spending sufficient time understanding what they are buying, and the legal environment is obviously different than in the US, and investors also do pay a very specific attention to that. Multiples are down. There's a discount vis-a-vis multiples in the US. That's obvious, but I would say those are the factors and environment.
No, very useful. Corey, I think we're running up on your time when you show up. So
that's okay. Just joining in for the last part. Go ahead.
Is there any more? Do we have a few more minutes, or are we up on time?
We have a few more minutes.
Okay, sounds good. Well, maybe just to kind of love to hear a little bit of insights. I think kind of as we look at the next 12 months or so, I guess, Danny, are there any areas that, kind of given the geopolitical dynamics, you're sort of, say, focusing on other markets, or, how's that kind of played out in sort of your, at least from a geography perspective? Are there certain markets that you're looking to support sort of in adjacencies, or has that really impacted any of your strategy?
Yeah. So first, I'll talk about Gilberto talked about nearshoring. So I do think that over time there will be more of a kind of a nearshore dynamic. In our world, there's a bunch of elements around it, even all the way down to the chip making, which we consume quite a bit of them. And so I just wanted to kind of call out and agree to that. And it would probably also shape kind of M&A as far as we think about companies that historically maybe we say we're okay to buy them in Asia and they will supply the US. We might kind of take a slightly different thing. Okay, well, maybe we should make it closer to DS. That's one element. The other one, we operate everywhere in the world, and so it's kind of hard for me. But the one country I will call out is China, which is, given everything that's going on there and the tension, the U.S. China, the evolution of what I would call these blocks, which is between the Russia-Ukraine issue, the Middle East issue, the China-U.S. We are seeing this emergence of these kind of two blocks, I would say, and China clearly represents one of the anchor in one of them. In China, we as a company are kind of evaluating how do we think about investing in China, broadly speaking. We have a very large business in China. China is going to be a growth engine. And so there's a little bit of interesting dynamic there where you're saying, on one hand, it's a very important market for me. It's high growth, it's good margins, and it's very large for us. But on the flip side, there's all these other risks that are kind of coming together with China clearly increasing the discount rate, if you want, on any investment you make there. And so that's one country that we're kind of continuously looking at how to invest, using more partners potentially, kind of looking at it from that dimension versus going on and directly kind of doing 100% M&A transactions in that market.
Okay.
That's what I call it.
Max, is there any other markets that y'all have been primarily North America and Europe? Are y'all looking outside of that, or sort of sticking to your current geographies?
Yeah, we're going to continue to invest in North America and Europe for sure. We're starting to dip our toes into Asia. And we're also interested in some other areas like South America and Australia. So that could be kind of longer term roadmap for us. So we're definitely looking at new geographies.
Okay. Virag, are you, sorry, Corey, are we up or?
No, it's finish up and then we'll
yeah, I'll do one more round. I guess Virag, we'll wrap up with you. I guess, are there any, you obviously have, expanded to multiple territories. I mean, I guess one, are there certain markets you're looking at, or are there certain things that you're using as your primary drivers to pick a certain market?
Yeah, we short answer, we pivoted a little bit in the last 12, 18 months. I think Max mentioned it as well, as the customers that we're working on that built our business, these small and medium businesses, they kind of retreated on order size over the last year and a half. And we saw our medium customers, our larger customers, getting bigger. So our volume actually grew, but that's a very different market and a different value prop than what we're used to seeing. So we're focusing now on acquiring more of that, and especially in Europe and in North America. So we see a lot of potential, but it's in a non-traditional world of our market. So that's sort of new to us, which means our asset mix is going to look slightly different as we get in the next 3 to 5 years. But there's markets like Ghana. The reason that you had mentioned Africa, there's countries specifically like Ghana that's, a lot of the edicts around why I think it's attractive for us, and Indonesia. They're trying to go further downstream in what they export. So if Ghana was exporting cocoa or nuts or coffee, now they're putting a lot of investment into making sure that there's customers there that are actually using that to roast coffee, make chocolate bars or mixed nut products to sell, and that requires packaging, right? So I think as you're looking for new places to expand, some of these trends are really important, and I think everybody has the same import strategy, or issues with bringing in from China and places like that. And Ghana was one of those places that said, listen, we're going to stop importing, packaging. We're going to try to produce it here, and we're going to incentivize companies to provide more value added in these markets. So
that's cool. Awesome. Appreciate you sharing that. Corey?
No, it's awesome. My tech team is telling me minutes ago that we have to stop, but I think the conversation is more interesting than falling behind schedule a little bit. But with that, I want to thank all of you for the interesting discussion and very good insights and good conversation to carry on. Stuart, always good to see you. Thanks for the moderation. Danny, it's always good to see you. And appreciate your contribution as well, Max, Virag, and Gilberto. Nice to meet you virtually, and appreciate the insights and the input. So thank you. We'll move on to our next part of the end of today's program, and our EndNote presentation from Brian Flynn, the Managing Director of Investment Banking at William Blair. Brian has been a member of the industrials group within William Blair's investment banking department since 2013. Hi, Brian. His focus has been on the packaging markets, and he has 12 years experience advising both buy and sell side mergers and acquisitions and public offerings across the whole packaging space. Prior to joining William Blair, Brian worked at Deloitte in their audit group. So, Brian, it's a pleasure to have you join us for this last part of today's program and providing kind of an end note summary session on the current state of the packaging industry with regards to M&A. So I'll turn it over to you.
Excellent. Thanks, Corey. Appreciate you having me, and thanks everyone for the time. I have the fortuitous position of going last of a great set of panelists throughout the day. So I'm a lot smarter right now than where I was 2 hours ago. So that's the benefit of going last. When I talked to Corey, he asked me to chat a little bit about the state of the M&A market. So that's what we'll do. Runtime will go about 10 minutes. I know we're running a little bit behind here, and then we'll open up for Q&A. So please feel free to throw questions to the chat. The last 18 months has been really, it's been a roller coaster. And the reason for that is we've had activity go up, we've had activity go down, we've had pricing go up, pricing go down, profitability the same. But at the end of the day, as we think about M&A activity, we're really back at where we started. We had a lot of activity. We've come back down as well. So there's been stocking, destocking, interest rates, inflation, sustainability, headwinds, considerations, opportunity. And those are just some of the factors that are driving M&A, and we'll dig into that further. So I am an investment banker by trade, so naturally I have slides. So that's what we've got on the page here for a few pages. Corey already gave my background, probably better than I can do it, but long story short, been focusing on the middle market, packaging M&A space for over a decade. Probably some familiar logos here on the page of either your companies or competitors or participants in the industry. And we focus across everything packaging, flexibles, rigids, medical, food and beverage, etc. We love the space, been doing it for a long time. Today, the agenda, we got a little bit of background on Blair. More importantly, focusing on M&A market observations and then outlook for the market as we go forward and key observations of M&A processes. So Blair, real fast, I think I limited myself to 2 pages. For those not familiar, Blair's a full-service investment bank. We're headquartered here in Chicago, which is where I come from, but we've got offices all around the world. We've been privately held for 90-plus years. We are a private partnership, not publicly traded. We got 2,000 employees, 20-plus offices. Investment banking, which is where the M&A arm sits, that's about 50% of our revenue. And then we also have sales and trading, asset management, and a growing wealth management practice as well for high net worth individuals. And then on the M&A side, we have 700 of the 2,000 folks dedicated to investment banking. We do about 200 M&A and capital markets deals a year. Average size for us is 500 million, but really we span from a couple $100 million up to a couple billion. So again, think about us squarely in that middle market. We're Midwestern founded, Midwestern based. So, we spend a lot of time in the packaging sector, and then given our private partnership, we love to partner with founders, family-owned businesses as well. So let's get into the meat of the conversation then. Market observations. So 2023, as I said, was a real roller coaster across the board. And as we see on page 6 here, there was a big spike and a big pull down in M&A activity. The real element as you think about it, what for 2023 is what's shown on this page in particular, is you saw the private equity investor pull out of the market. As interest rates rose and inflation rose, as well as investor sentiment pulled back on the threat of recession, you saw individuals in the private equity market in particular pull back, which created a large air pocket. You see the amount of deal volume going down, 50% increase in market volume for private equity transactions. What's interesting, though, is if you were to take out the 21, 22 spike and pullback, 2023 probably wasn't as bad as maybe it would have felt. If you look back over the 2017 to 2019 period, which historically was viewed before COVID as a great period for M&A, the deal count was above the 3-year average, 2023 versus the average of 2017 to 2019. And the deal value, which is down at the bottom of the page in those blue highlights, that was only 12% below for 2023, what was 2017 to 2019. So helpful to put things in perspective that yes, we're down off of 21, 22, but potentially we just pulled some of that activity forward into those years. And we're seeing actually not as bad of a year as possible. I put this page in here because I think, for the investment banking colleagues and folks that have been on the phone, this is kind of what it felt like in 23, right? We've come off 21, 22. Running the Bulls was a lot of fun and a lot easier than running with the Bears in 2023. So myself and the other investment banking compatriots here definitely, feel like the individual on the floor. But, going back to maybe drinking from the half glass full perspective that we talked about on page 6, as we entered the year, there was room for optimism. You compare where 2024 was versus 23, and we looked at a better equity markets. Inflation was right sizing. You saw the interest rates peaking and maybe even potentially coming down. So you saw optimism at the start of 24. If you roll that forward to the bottom part of the page now, you're seeing that optimism continue to play out in the lending market, which obviously is a big driver of M&A. Right now, you're seeing the interest rates have been flat for some time, dating back to Q3 23, and you are seeing the market pricing in 2 interest rate cuts, albeit that is less than what they were pricing in at the start of the year, which they were thinking about 6 interest rate cuts over the course of this year. But nonetheless, we're not seeing a reversal to interest rate rises. We're seeing still an anticipated 2 cuts. And what's interesting in the bottom right part of this page here is our leveraged finance group at Blair. They do a survey of a couple hundred lenders every quarter. And you see the outlook for this, the William Blair Market Index for lenders. This is their outlook. And anything over 3 is a borrower-friendly market. And so you see where we were back in 22, 23 when the market was effectively shut off. You saw that down at 2, which is effectively where we were during COVID when the market froze. You were seeing us back up to a borrow-friendlier market. On 9, as we flip to this page now on some of the data, we're seeing that optimism, the bullishness that I was talking about on the forward indicators, that is playing out now on deal flow activity during Q1 24. We're up 44% globally across M&A for Q1. And then the US, we're seeing a 75% increase. Again, this is deal value and it's a short period of time. So not ready to pound the table yet and say we're back, but we are seeing some of that bullishness come back to the market, which is positive. As we think about perspectives then for the M&A market, wanted to talk through a little bit of what we saw on the process dynamic side of the market in 23, and then we'll shift towards what investors are looking for in 24 and maybe some of the outlook as well. So in 23, we saw a lot of processes, M&A processes get smaller. Investors were being much more selective in the deals they looked at. Candidly, maybe using the word even fickle. And you saw investment committees for private equity investors shutting down deals as they got to the late stage. As a result, we are thinking now, if you flip to the bottom of the page, we're thinking about the processes being wider. So broadening the aperture of investors that we are targeting. And for that, in order to drive additional competition. So you're seeing that play out. You are also seeing more multi-stage processes play out. So for anyone on the phone here that's thinking about participating in M&A from a buy-side perspective, you'll likely see these broader processes, but multi-stage processes where you have the opportunity to diligence the business versus just having the opportunity to try to quickly run to a preemptive situation, which is maybe where we were back in 2021, where there was the risk that someone would run faster. I think you'll start to see folks play out the process more and allow folks to get behind a lot of their diligence considerations and make sure they have a good, strong footing for the bids they put forward to ensure closure for the transaction. As you think about the diligence focus areas, that's what's highlighted on the right. as I mentioned, we've had an up and down, left and right type of market for the past couple of years. And so the list of key diligence focus areas is large. Some of these are probably obvious, price volume trends, given the dislocation we had in the materials market, destocking, post-COVID bumps. Folks would like to understand what's driving the growth of businesses and is that sustainable? And one of the other developments we've seen is from 21, 22, investors had an appetite to pay for forward earnings or run rate adjustments or pro formas. We're seeing that pull back, and investors are resorting more to LTM type EBITDA levels for their valuation to drive valuation instead of pro forma run rate adjustments. One of the things that we're advising potential clients to do is take that diligence list of things that folks are focused on and build out robust analyses. Folks, although the investor sentiment continues to enhance over the past couple of years, or the past couple of months, I should say, you are still seeing a prove it mentality. And so talking about your diversification, your price volume analysis, your innovation is great if you're selling a business. What is important, what we're seeing in this market, is a need to have quantitative support for the qualitative attributes that your business is selling. So an important aspect is doing the preparation work up front to enable a faster, smoother diligence process whenever you elect to go into market. So what's the ideal target? That's on page 12 here. And we're seeing a handful of characteristics that investors are looking for within packaging. Now, if you're looking at this list, say my business doesn't tick all these boxes, that's okay. This is not, you need to fill all of them, but hopefully this provides some North Star to work towards, or, a nice pat on the back for you and your team if you're achieving any of these metrics. So organic growth, for instance, is very important. Given where we are with the interest rate environment, you are seeing M&A roll-up strategies have a higher bar in order to be valued. As a result, organic growth is getting much more of a focus. Organic growth volume is being valued much higher than organic growth driven by price, right? And so the organic growth by volume is viewed as more sustainable. So folks are putting more stock in that. If you are doing M&A, right, the ability to have a robust pipeline, the ability to do it multiple times over is important. But there is a fear, right, in terms of valuation perspective of a lot of recently acquired EBITDA getting full credit from valuation. So something to be considerate of if you're thinking about launching a sale process, sometimes making sure those recent acquisitions have been integrated. A few of these others, recession, proven performance, are probably obvious. Sustainability is one to touch on. It's the top focus for everyone in the packaging industry, right? I think sustainability has evolved. Before, it was a topic that we would have on one diligence call at the end of the process. Now we are having whole diligence modules dedicated to sustainability for investors. We're actually advising a lot of our clients also to engage third-party sustainability specialists to build out reports similar to what you see from a quality of earnings report as well. Someone on the last panel asked, what are the metrics that folks are looking for? There's not one set of metrics. That would be too easy. So it's a broader set. But some of the verticals that folks look at these sustainability goals is looking at it through operational enhancements. Have you enhanced, or have you reduced the amount of electricity, water, power that's coming into your facilities? From a product standpoint, have you increased the amount of post-consumer recycled content in your products? Or have you developed new innovative material uses for your products? So can you use a PLA type material instead of a virgin resin? And you're also then seeing case studies as well being utilized. So a lot of folks have these innovations that are on the shelf, the opportunity to use. The more you can commercialize those types of sustainability-based products and show that there is a proven ability to commercialize, the more credit you will get for that sustainability story. There has been evolution in sustainability where before there was a sustainability premium that was applied to businesses well founded in sustainability. would say that's shifted a bit, where sustainability is now more center of the fairway, more expected. And there's actually probably a valuation discount being applied for some businesses that do not have a strong sustainability story or are viewed as being at risk of sustainability pressures impacting future demand. Lastly, on this page, last two here, clean earnings, EBITDA adjustments. There's been a lot of noise, right, in people's performance over the last handful of years. So obviously there's going to be a lot of add backs, adjustments there. Would be mindful for folks that are considering a sale process here. If you're going to market with two EBITDA adjustments over reported EBITDA in excess of 25-30%, you're likely going to get pushback from investors. It may be better to wait a handful of months to allow those adjustments to roll off and allow the spread from reported to adjusted EBITDA get a little bit tighter. And then openness to seller rollover. As I said, investor sentiment continues to get better. We're continuing to see buyers looking to spend, looking to deploy capital. But the openness for sellers to roll over capital in a transaction is always viewed as a positive sort of insurance policy of sorts. So what do we think for an outlook then for the next couple, for the next 6 months of this year and likely going into next year? I think what's interesting is there are a lot of tailwinds. As I mentioned, interest rates continue to be a view that they will be coming down, which will be positive, especially for the private equity community. We are seeing bid-ask spreads on valuation tighten. Buyers are recognizing that they may need to move up in terms of their values. Sellers are recognizing this may not be 21, 22 anymore and may need to pull down a little bit. And we're seeing that tightening, which is getting us closer to seeing more M&A transactions take place. Not fully there yet, but we are seeing that take place. The amount of capital on the sidelines still is incredible, in the trillions. It's amazing. That capital needs to be deployed. So that provides a lot of supply of capital and a lot of demand for M&A in the future. And also, a lot of businesses are backed by private equity and they need to return capital to their limited partners. So that'll provide more businesses coming to market as well to meet that flux of capital that needs to be deployed. So a favorable outlook for when we think about what's going to happen in 2025. And then, lastly, we are seeing a proliferation of transaction types as well. And so before it was just, I'm going to sell my business to XYZ buyer. Now we are seeing a lot more partnership transactions, continuation vehicles, minority sales. There is a whole suite of solutions for how you could potentially transact in the current market, which happy to follow through on maybe a separate conversation. It's a little technical for this one. With that optimism, though, I would say there are some headwinds, right, or potential headwinds, potholes that we may trip up in this market that could delay the return to the M&A market. There is geopolitically, there is the U.S. election coming up in November, which it will be good viewing for the next 6 months in terms of drama. It doesn't feel like there's a lot on the docket right now that would impact the M&A market, but if I learned anything about U.S. politics, don't forecast the future there. There's also continued, geopolitical considerations more broadly outside of the United States as well that could impact supply chains. Elevated cost of debt. If we don't see this inflation wane as the Fed is hoping, and we're to continue to push out interest rate cuts even further into 2025, that could provide pressure on the M&A market as well. And then there's still public markets are creating valuation challenges versus private markets as well. So as you think about that bid-ask gap or spread, there continues to be some movement there from the public markets that are continuing to keep that spread wider. But you are seeing investors be seasoned to not look towards public markets to drive what they're thinking about in the private market aspect. And then the last one I hear, it's not on the page, right, is sustainability. We already talked about it. You are seeing an evolving regulatory market over in Europe. One of the panelists earlier talked about that we're all one world. We're all working to drive sustainability across the world, so they don't think about sustainability in the regions. I agree with that comment. I would say Europe is ahead of the United States. So as you think about European regulatory sustainability aspects over there. You are seeing a lot heightened in terms of sustainability pressures, which you are not seeing here in the States. That's not to say that we should be blinded to the fact that some of those sustainability regulations could come over to the United States, but you're seeing that on a delayed aspect. But as you think about packaging M&A for the next 3-5 years, sustainability will continue to rise in focus. And for businesses that don't have that sustainability profile overall, that they could face, headwinds as I've outlined on this page. So before we flip over to Q&A, I mean, maybe just to wrap up real fast here, the market has been, up and down over the last handful of months. We are seeing across William Blair a continued momentum across the board in terms of the rise in M&A. We are seeing more M&A activity in packaging as well as our broader industrials platform and across the broader bank. We're excited that the return to M&A is, happening right now. And we think 24 and more importantly, going into 25, it should be a very active year for the M&A market overall. So with that, Corey, maybe I'll pass it over to you and see if we collected any questions throughout the conversation.
All right. Thanks, Brian. That was an excellent end note and summary from your perspective. There is a question in our chat. I have a couple questions myself, but let's get to the question from the chat. It reads, I've recently reviewed converter performance trends and have seen the gross margin of larger roll-ups trending down from 27% to 24%. The largest cost structure reductions come in the SG&A area. Keeping this in mind, has the expectation of the investment changed meaning? Has the payback expectations been lowered by the investment community?
Yeah. The payback from M&A, I don't think has been lowered by the investment community. I think they're still underwriting, a similar level of returns. I think what you're seeing though is the gross margins coming down, and even some on the SG&A side as well, right? You're seeing businesses continuing to react to an evolving market. And so you're seeing increased cost pressures across the board from, all different aspects, materials, supply chain, energy, et cetera. That's impacting your gross margins. Some of that's been able to pass through, but some of that is a little bit more sticky, which impacts gross margins. And on the SG&A front, while we're trying to get more and more people back in office, you are seeing folks still dispersed across, the broader global footprint of businesses, which at times can put double costs into the P&L, which also has put pressure on the bottom line.
Great. And I have a question. I'm going to revisit a question that was put forth at the beginning of today's program in terms of where do you see multiples today, and where do you see them heading, let's say, in 25 and beyond?
Yeah. I'll try to put some numbers around this to give folks context, but obviously every business is different, right? So I wouldn't this is painting with a broader brush, but I'll try to put some numbers around it. When we were back in early 23, I would guess there was probably a 2-turn gap between, or 2-turn discount, I should say, in terms of where we were from 21, 22 to where we were in early 23. So a decline in valuation of around 2 turns, maybe 2.5. How I got to that figure is we had about a turn to a turn and a half decrease in terms of the leverage available. And then you also had a turn decrease as a result of just investor sentiment thinking about a recession. As we go forward to where we are today, I think that 2.5 turn decrease has probably shrunk to maybe around a turn. And we're actually seeing some tightening even there as well. Investor sentiments increase, as well as the amount of debt available for LBOs has increased. So that's put upward pressure on valuations. It is still more expensive for debt out there in the marketplace right now. So there is, for businesses that don't generate a lot of cash, they might not have benefited from that same rise in valuation. But in general, you're seeing a rise in valuation. We're still probably a turn below where we were, but it's getting better. The one aspect, though, I should say, which is In 21, 22, folks were valuing businesses off of a forward earnings. And today we're much more focused on LTM, or last 12 months historical earnings. So while the multiples may only be a half turn difference, depending on the composition of your EBITDA and the amount of growth in your business from a forward perspective, it could feel to you like there's still a larger discount in valuation than what you than maybe what's observed from just the multiples.
All right, great. And also from our audience, another question: is there a rule of thumb for the ratio of CA to CL of working capital to be delivered on a typical cash-free, debt-free transaction?
Yeah, I would say a rule of thumb from a net working capital perspective. It's each business is different, right? And so you're going to look at over a longer term period of time, 3 months, 6 months, 12-month average for those types of businesses, taking out one-time items. We try to have it be 12 months usually is where you look at, because it takes seasonality out of the focus. I think that's where a lot of folks start from a rule of thumb perspective. But you will see in certain instances 3 or 6 month averages being used there as well.
Okay. And final question from the audience: what kind of value creation themes are of high interest to private equity sponsors in today's environment?
Yeah. I would say value creation themes. The ability to drive organic volume growth is item number one for private equity investors. Historically, they've loved M&A type transactions, the ability to do add-ons. They are still underwriting add-ons, but organic volume growth has been a big focus for them. And where you are getting that organic volume growth is also important. So if you're getting that from your non-sustainable legacy products that are going away, but you're seeing good growth there, that will be valued at a lower discount than maybe getting good volume growth from your sustainable based product with higher margin, which is more exciting. So a lot more, to my point earlier in the presentation, I think private equity investors have been very versed in the broader packaging industry for some time now, given their level of activity over the last decade. They are digging into the details much more rigorously and assessing those price volume dynamics and SKU level dynamics. So spending a lot of time in advance of a process to make sure that you are pulling out quantitatively a lot of things that are driving value is important.
Okay, great. And maybe one last question from my side, just to swing back around to a common theme that's been brought up throughout today's program, and that's around sustainability. Do you think that a compelling sustainability story differentiates enough to provide additional value to a particular asset? And do you find investors are willing to pay a premium for sustainable oriented companies?
Yeah, I think so. And we have seen time and time again, sustainable based businesses drive a premium. Some of that is sustainable based businesses tend to be more innovative, tend to be higher growth, right? And so sometimes there's a little bit of chicken and the egg of what drove the higher valuation. But in general, we are seeing folks that are at the forefront of sustainability, garnering higher valuations. I would say, to maybe a little bit to the question or you just asked about private equity sponsors, private equity investors are craving sustainability centric stories. Their LPs are pushing them to deploy capital in sustainability driven businesses, and having a good sustainability story helps private equity investors get transactions through their investment committees. And the last point, Corey, is I know we got to wrap. I would say, and I think I've mentioned in the presentation, the focus on sustainability has shifted along the continuum, where now you are seeing businesses actually receive a valuation discount if they do not have a compelling sustainability story, where historically it was you would only get a premium if you had one. Now it's shifted a little bit more where the expectation is you have to be addressing sustainability. You'll get a premium if you have a really compelling story or you're doing a circular business model. You can get a premium there. But conversely, we now have a proper bell curve where you can also get a discount if you are not addressing sustainability. So we would encourage all folks to continue to advance their sustainability initiatives. Not only does it help probably your business and the environment, but it'll also help in an M&A context.
Awesome. Good way to wrap up the discussion. Appreciate the insights, Brian, and the time, and thanks for joining us and sharing with us your expertise.
Excellent. Thanks, Corey. Appreciate it.
Thank you. Well, that certainly ends today's program. And again, thanks, Brian, and thank you again to Thomas, Blaise, to Duramirda, to Stuart, and all our panelists that contributed to the discussions today as we work through our program. I'd like to just conclude and thank again, Blaise and Company, Mergerware, Mazzone and Associates, William Blair, and Graphic Arts Advisors for their support and sponsorship of today's program, and would like to thank the 200 plus registered participants and those who joined us, while some will be reviewing the video recorded proceedings that will be available on the platform after the close of today's session. So thank you all for joining us. And again, thank you for the moderators and the contributors and panelists. And we look forward to seeing you at the next AWAVirtual Mergers and Acquisition Executive Forum in 2025. And enjoy the rest of your day if you're in the US. Enjoy the evening if you're in Europe, and have a good night if you're in the Asia Pacific region. So with that, I'd like to thank the AWA team for their back office support, and look forward to seeing you again at another AWA event. Thank you.